Hello traders, it's Friday, February the 21st. This is John Kicklighter, Chief Strategist for DailyFX.com. Here to give your FX market wrap-up for the past 24 hours of trading and an outlook for what we can expect in the final 24 hours of trading this week. This past 24 hours was one of correction. I was looking for an expansion in volatility, something that can give us enough momentum to try to finally break some of these very immediate technical levels, clear the way for us to some bigger follow-through. However, we wouldn't have it. That was despite a very significant round of event risk this past 24 hours. It included CPI data from the United States that is incorporating more of the taper concern, European data that was the PMI numbers that are good leading indicators for growth expectations, and a number and range of other indicators. All right, so what we are seeing is a market that is not ready to break its complacency, but it has to, inevitably. Looking at my general assessment of the situation, the close-in technicals, the very high susceptibility to volatility, the possibility of seeing a break that can easily turn into a trend, and of course the bigger fundamental bearings, the bigger fundamental lean towards complacency. I think all of this is wrapped up very nicely by the S&P 500, playing all these roles very well. With the S&P 500 after that incredible run that we had, whether you're looking at the CFD, whether you're looking at the futures off the E-minis, that was a really remarkable run. 9 days for the CFD, 11 days for the E-minis. The longest run for the E-minis actually, or the second longest we had on recent record. But this move does not necessarily mean that you're going to immediately have a reversal. This is something we talked about, particularly with consistent runs like this. We had that consistent run, and yes, it ended that 9-day rally for the CFD, but it didn't necessarily mean that we were pitching into a fresh bear wave. Instead, you can see we had a sharp decline, and it stalled in its momentum almost immediately. What this reflects very well is the underlying assessment of volatility. We've been watching the ATR. As I said, this is a great measure of activity level. The ATR is a stand-in for some of the more traditional measures that we often talk about, but aren't necessarily as accessible, like the VIX indicator, or if you want to look at the historical or actual volatility of the markets. Those aren't necessarily as easy to come by, especially if we're looking at something where we're referencing all the various risk assets and trying to ascertain our market's relationship to that one predominant theme. It becomes very difficult to do. So as a simplistic approach, we can always use this ATR. A level of volatility is very equivalent to what we look for in terms of trading for volatility. Breakouts, preemptive breakouts, follow-through trend, momentum, all of this can have some kind of anchoring in these volatility trends, these activity levels. And as you can see with the ATR, we had that remarkable run with this rebound, or actually initially the decline, and eventual rebound here. And we were building up volatility into that rebound initially, but as you can see, as we closed into the top, the range high up here at 1850, which actually happens to be the record, it started to lose momentum. All right, that's exactly as we would expect it. And of course, those two very narrow range bars, subsequently those would be some of those inactive periods that we have. And now we're starting to ease back on the activity measure. And that's exactly what we would expect, because we have come into meaningful resistance. The market is taking its time and waiting for direction. It's not very easy to sustain volatility without a meaningful level of direction. Eventually, we have to put this volatility to use, and it develops into momentum. Otherwise, it will burn itself off like excess energy. So when I look for risk trends, whether risk aversion or risk on, and whether I'm applying that to just equities, whether I'm applying it to the yen-based crosses, or whether I'm applying it to something more exotic like the emerging markets, this happens to be the dollar ZAR, I look for these technical bearings. You can see, relatively speaking, that most of these have the same kind of resistance in place, and it's about proximate to what we're seeing with the S&P 500. 1850 happens to be the S&P 500's benchmark, or overhead resistance. The ZAR, as you can see, is a swing high at around 1110. We can look at some of the yen crosses like the euro yen. The 141 handle is going to be our immediate resistance. And we can even look at the other global equity indexes. Nikkei 225, 15,000, we've been following up pretty closely, and the DAX, the German index, probably that swing high that we have up here is at 97.75, although you can go down to 96.75 for the recent, I would call it a right shoulder on a head and shoulders pattern. So we look for these risk themes, and this is where our best potential lies. This is why I cover this on a daily basis, because it's where the best potential lies. Probability says that it's not going to be an immediate breakout risk, all right? But you can see over time that as we get closer or tighter and tighter within these patterns, whether we're talking about the S&P 500 or whether we're talking about the yen crosses, as we get tighter into these wedges, they're more likely to break out. Exactly like the dollar CAD. All right. The dollar CAD, as we were talking earlier in the week, before it had the breakout, it was working its way deeper and deeper within this wedge. It eventually had to run out of room. And though this is a pair that is not prone to high levels of volatility and big breakouts, it necessitated a breakout. The same kind of circumstances exist for the S&P 500 and risk trends in general. A breakout is a necessity. The question is when and under what circumstances. Because if we have a breakout that is going to be like the dollar CAD and is just encouraged because it ran out of room, the follow-through is going to be relatively limited. That's why I look at this 1850 and I see the possibility, high probability actually, of a break to the upside, looking at the bigger trend. But the follow-through is going to be very, very difficult to sustain. It's more likely we get a false breakout to the upside and subsequently see it reverse and pull us right back into a difficult range. The kind of progress we saw when we had this break of this upper channel resistance up here, and then it kind of floundered. All right, that difficulty in getting follow through is a testament to the positive bearing on risk trends. It is not an easy thing to sustain because we are already very excessively priced. Whether we're talking about a reduction in the exposure to uncertainty and risk trends, or moral hazard, if you will, well priced in. If we're talking about the outlook for growth, that is starting to come down. The possibility of more capital flowing in. Well, more capital is not flowing in. Volumes are shrinking, but at the same time, leverage is being used to compensate. And this is already becoming an extreme in and of itself. So, in the next 24 hours, the final 24 hours of this trading week, is there a hope that we can get a break in risk trends, whether it be bullish or bearish? Because we can see, definitely, from these yen crosses, euro yen has potential of breaking the upside just as much as it does the downside. My pound yen, which I still have the second half of my short on, although the stop's been trailed up to break even, so it's actually pretty tight to where we are now. I already took the first half earlier at 135 pips, but this can break to the upside or the downside, break this descending trend line, or break this congestion pattern here and what is loosely a head and shoulders pattern below 169. We can see the same kind of pattern through most of these risk trends, and in fact, I would even say that beyond the dollar yen as a major sensitive to risk trends, even the majors, the more liquid majors, have a possibility of short-term break. Euro dollar, if it breaks this recent congestion, breaking above 130 is going to be, or 138 would be very, very difficult to sustain. Getting above 139 is going to be virtually impossible given the fundamentals that we have within the short time frame that we have. But in the meantime, in the short time frame, we can break this recent congestion and get below 137 or above 138, make for a little bit of a move, but follow through is perhaps a little bit beyond our bounds. We'll probably have to wait until next week. Nevertheless, the sensitivity to risk trends is probably going to be quite high because there aren't other major fundamental themes weighing in. The same thing is true of the pound dollar. All right, this too has a recent sensitivity to risk trends, and this has probably been under the stewardship of the U.S. dollar alone. You can see here with the Dow Jones FXCM dollar that this benchmark currency has been charging higher for 4 consecutive days. Hasn't been a very productive 4 days, but that's exactly the same kind of conditions that we had on the way down. All right. In general, activity levels are shrinking. They're getting very, very quiet. This is as quiet as we've seen since early 2013, back in the holiday period then, and then before that, we really don't have comparable activity levels since 2007. All right, this is really quiet conditions, but these conditions have been quiet for quite some time. So it's not a high probability or a reasonable expectation to think that conditions will automatically change just because we're paying attention. We have to look for something reasonable that can get these markets moving. So what can get these markets moving, or what does have a possibility of moving over the next 24 hours? Well, I wouldn't write off general risk trends. If you have just a speculatively derived break, whether it be tripping stops or a surprise piece of event risk or simply a waterfall of sentiment, always a possibility. However, it doesn't look like we have a lot of definable catalysts that can win that. I'd be watching two things in particular. The G20 meeting, and certainly you're going to have, we've already had some remarks that were released there, topics of conversation, including emerging markets and their concerns about volatility, structural growth structural growth expectations that they have and trying to promote it. We'll see what the individual policy officials come to each day of the meeting, but realistically speaking, they're not under pressure to push through anything right now. So I would not expect remarkable, mind-blowing policy changes, and certainly not within the time frame that would make it tradable in the final 24 hours of this week. Of course, we'll always watch for surprises. And then I would also watch policy officials speaking into the end of the week as well. We have Bollard and Fisher. Both of these policy members are proving themselves to be very hawkish. They've kept to that hawkish script for some time now, but they really haven't stirred a lot of activity on the dollars front, whether we're talking about taper or whether we're talking about risk aversion, as the reality of moderating U.S.-based stimulus is becoming reality. All right. In this past session, we did have something that was a little bit more tangible on the dollar front, whether we're talking about taper, whether we're talking about taper's influence on risk trends. And that comes from CPI. The figures, while in line with expectation, the headline CPI figure did step up to 1.6%. All right, this is adding a inflationary pressure, while we're still a ways away from the 2% target that the Fed has. As we near it, it tells us that we are going to get closer and closer, not just to not just confirming taper, but more importantly, inevitably drawing closer to that first rate hike by the Fed. Certainly not on the docket for the immediate future. However, we don't price things as they come. We don't price things just 24 hours in advance. The market prices whatever it can, especially the important things like rate hikes in the FX market, swaps markets, and bonds markets. They're very important. And as we start to see the outline of a first rate hike later down the line for the U.S., that has severe implications for the greenback and for the global capital markets. So we saw this inflation pick up. I colored it red not because it's red for the U.S. dollar or bearish for the U.S. dollar. It's actually bullish for the U.S. dollar. But this is my manic crisis calendar, so I have to assess it in terms of what it does for risk trends. And what does the possibility of a rate hike do to risk trends? It reduces risk appetite. It encourages investors to be more safe in the way that they position, not dependent upon open-ended stimulus programs. Now, in terms of the data, there was a pretty uniform improvement in the economic quality of the data, manufacturing activity, the economic expectations from the Bloomberg survey, and the housing figures, the mortgage delinquencies and foreclosures, all of that showing significant improvement, while in good contrast, the European PMI figures, which are GDP proxies essentially, showed a significant deterioration. All right, that was a very good contrast for particularly the Euro-USD, but we wouldn't necessarily get a lot of traction out of it. Why? Because the markets aren't necessarily paying attention to the economic troubles in the Eurozone. If they were, we would be a lot lower than we are now. They're paying more attention to the capital inflows as investors seek out those higher rates of return in regional bonds. Whatever we can do to reverse that trend is what's going to be the bearish exclamation point on the euro. And we haven't seen that yet. That's in general just going to be a high level of volatility. And we have not seen sticky volatility just yet. But I do want to look a little bit closer at that discussion about the taper and the implications of an eventual rate hike from the Fed. We are seeing that the interest in the taper is picking up a little bit. You can see it here. The markets are paying attention, and not just, I'm realizing the taper, but more of we're more interested here in the realization that the taper is a predecessor to a rate hike. All right, so you can see that interest is starting to pick up, and that can eventually give the U.S. dollar a very big boost as long as it feeds into interest rate expectations. All right, and that 12-month interest rate expectation is still the highest we've seen since 2011. What we want is something that is far more conducive and far more sticky from a yield perspective. So we want to see a continued rise in the 10-year yields, and especially the 2-year yields, because those are going to be more along the time frames of interest rate expectations. So risk trends and monetary policy, both of these themes are still big, but not necessarily active drivers for what we have in the final 24 hours of this trading week. If there is going to be a possible volatility event, it's more likely to happen from a currency that we don't usually pay too much attention to. While this is low of importance on my manic crisis calendar, meaning it has relatively little influence over global risk trends, this can definitely move the CPI figures and the retail sales figures, can definitely move the Canadian dollar if there is enough surprise from them. That should give us some interesting developments for a couple of interesting currency pairs that we've been watching. The CAD yen has been very open to volatility as of late. That's because a lot of activity on the yen counterpart, but you do have a lot of very clear technical bearings, clear base levels. 98 and 91.85 is the current resistance that we have, support. 92.50 resistance. You can get beyond those levels and start pressuring bigger technical bearings. But this is definitely a currency pair that's going to be sensitive to risk trends and the CAD data. I would also watch Aussie CAD, a trade that I still have the second half of this position on. I booked the first half, I believe, at 95 pips. The second half, I trailed it to break even, but we never got back down to test it. As you can see, it's a rising wedge, and it's coming right into this meaningful resistance, this gray line here. What does this gray line represent? Well, it's a peak that you can see that goes back to May. If we can break that, it would be a continuation of this upswing and momentum, but it's always possible to break to the downside. We need a reason to actually get beyond either of these levels. All right, this is actually very similar to the Aussie USD setup, which is already pulling back from its own resistance up here. But the Aussie CAD is a great CAD opportunity, especially its proximity to the technical level. If we have a negative outcome from the CPI figures, and negative from the retail sales, it removes the possibility of immediate rate hikes and growth potential, which is a big drop for the Canadian dollar, and that would be what we would need to break parity and move further into the upside territory. Dollar CAD has already made its move, but it can definitely look for something that gets it closer to that 112.50 level and continuing its trend higher, or perhaps put us back down below that 110 level. So we have some volatility potential in the short term, but it's not necessarily on pairs that draw too much attention. Of course, we're not here to look for the most popular. We're just here to look for trades that look like they can set up and work. In the meantime, I will be watching very closely pairs like the euro dollar. All right, I think this has, especially in the medium to long term, these technical patterns have to be broken. All right, they're running out of room, but it will take some pressure and potentially some big high-level ticket fundamentals to actually get it moving, but it's worth watching. The same is going to be true of the pound dollar. I'm still looking for it to drop below 162.50 or 166.50, 166.25, or if it will, a break above that 168 level. But this is a great opportunity when it has the momentum. All right, these are great potentials, just like risk trends. This is a very, actually, while we don't have much in the way of high-level event risk in the next 24 hours, this is so proximate and so sensitive to sudden swells in volatility that the S&P 500 has a high probability of seeing a tentative technical break, like a break above 1850, given that we are just so close. But follow through, you have to be very restrained in your expectations there, because it has to be driven by something that can sustain a move. This is already a very mature rally. To get it moving even further requires some further confidence in the markets that would induce capital inflow, which is difficult to do. And on the other hand, if you do have a move to the downside, Follow through is actually a little bit easier there because we do have a market that is, as I said, susceptible to volatility. But we need to have these fundamental cues. Too many people are asking me what to do with these types of setups that haven't actually set up. The best thing to do is just to wait for the setup, and that includes technicals and fundamentals, and secure those market conditions. All right. So keep an eye on these markets and watch these pairs, both the ones that have immediate potential, but also the ones that have the bigger opportunities when they fulfill their obligations. All right. Good luck trading out there, guys, and I'll wrap you up for the week tomorrow.